Hello and welcome to Core Finance and my guest Craig Erlam, the Senior Markets Analyst at Oanda. Welcome, Craig.
Thank you.
And today we're going to look at the euro dollar. So tell me what you see here.
Yeah, it was looking quite toppy for quite a while. We had that nice little head and shoulders forming just above 120. Every time we broke through 120, it seemed the ECB was doing everything it could to drive it back below. There seems to be a fear level for the central bank. We had this nice rising trend line, so again another very nice technical chart. Once we hit that second shoulder, it was starting to become quite apparent that there was, we were losing some of that upside momentum, and we were just waiting for several confirmations. The first confirmation came from the break of the rising trend line, which we saw again a few weeks ago. We saw a break of the previous lows, which took us through the neckline of the head and shoulders, and then you start to get possible price projection levels, which indicate more downside. We came back below towards those kind of 116.75s, where we found support from the previous lows. We've now had a retest of the neckline again. Now, there's two things that you can often see here. One, you can sometimes see a rotation off of the neckline. The previous neckline support becomes resistance and tends to suggest we're going to see more of a downside turn. The alternative, if we break through the neckline, that doesn't necessarily negate the head and shoulders which is formed and suggests we're going back into a bullish pattern. Usually I then like to add the Fibonacci levels. The 50 and the 61.8 in particular tend to mark good potential resistance regions for a rotation to the downside. I still think there's more downside to come. Two reasons. One, I think the euro got overextended, a bit overexcited maybe, and two, I think the dollar has become dramatically oversold over the past 10 months, and I think once the market starts pricing a bit more from the Federal Reserve and start to realise how maybe overextended this has come, I think we could again comfortably be looking at 115s, for example. In this pair.
Certainly the US dollar index has been the main driver of a lot of this. It's
exactly.
just been general dollar weakness. So.
Absolutely, and I think we do need to see a bounce. We've seen a brief bounce over the last few weeks in the dollar, but ultimately, compared to the 10% the decline that we saw from the start of the year, I think there's more to come, and especially if the Trump tax plan does get through finally. I think that the potential for upside in the dollar is very, very much there.
It certainly would suggest that. So from a technical trading point of view, really a break of that recent low is going to be key for
absolutely
for playing it to the downside.
Another thing I really like here, not many people use the moving averages in bands. That's something I quite like to do, and I use the Fibonacci numbers as well. So the two moving averages that you can see here are the 55 and 89 moving averages. And one of the things that I notice quite a lot with these is you tend to see them, like say, just act as a pair. So it breaks through one, finds support on the other, then finds resistance back at the first one, and then before the break lower. So that 118.20, it's not just the neckline of that previous head and shoulders, it's also the 55-day simple moving average. So it marks a possible rotation point.
So could be a shorting opportunity right here.
Possibly. We'll have to wait and see.
Thank you very much.
Thank you.